Hi, this is Mark with your analysis for the week commencing the 16th of June. Just before we go into this week's analysis, as ever, let's have a look back at what happened last week. This is the Australian dollar, and I explained last week that there was a good chance that the Aussie dollar would gap after bad economic news out of China over the weekend, and the reason being that Australia is a big trading partner with China. And it turned out to be spookily accurate, because what happened? The previous Friday, price had closed here around 94.95, and on Sunday night for me, Monday morning for some of you, the new candle opened almost 100 pips lower if you measure from here to here. Now, I have shown you previously how I trade gaps. The theory behind a gap is that the gaps 90% of the time will close. Usually fairly quickly, sometimes in this case later in the week. So this gap here has opened. Now the significance of this gap was it stopped to the pip around 9400, and therefore it was a major previous area of support and resistance. And I showed you in Wednesday's update how this had been a previous line of support and resistance going back many years. So price has gapped, it has dropped. Where was it likely to stop? It was there. You enter, you get your stop to entry as soon as is possible, and you hope to catch the move. And I showed you how there was 90 odd pips to be made out of this trade. And also, not long after the market opened, my best trade last week was the dollar yen. And the dollar yen, I had said after the market closed on the previous Friday, we had this pin bar candle, so it looked bullish. But I said I was going to place a forward order to short at 98.60, and I showed you how I would place my stop just the other side of the trend line. And the reason for this, it was a break of a major trend line that goes back to early in the year, and therefore traders all around the world would have been watching this. It was also an intersection of a fib, and the 55 EMA on the daily was rolling over as well. So lots of areas and lots of reasons here of confluence why, if price was going to react anywhere, that was the key. Now, I showed you in Wednesday's update, I got out too early, but I managed to take 130 pips from this move. With the benefit of those hindsight glasses, it would have been obvious that you should have stayed in this. To stay in, one method for trading off daily charts is you simply move your stop down behind the candle each day, or sometimes 2 days. Markets have been messy. I wanted to bank some profit, and thankfully with those two trades I was out of here by Tuesday, which suits me fine. Now, I mentioned the previous week, don't beat yourself up, because this move that I had pre-planned and explained to you the previous week went almost 500 pips in the end. But you have to have the mindset that you won 130, not that you missed another 300. Because at the end of the day, as I say, it's all so easy as Forex. You look after the event and you say, oh, why didn't you do it? Learn to walk on, whether it's a good win or a loss or a partial win. Accept what you've got and move on. What else happened last week? You have to forgive me, this is my demo account, and I was away Friday and didn't get home in time, and to be honest, I'd forgotten to cancel some orders. So I had an order in place. My preferred entry on the pound last week was to long at 53.30. Price never got near. I did point out that there was a potential move down here as a counter trend swing trade, but I wasn't going to take it because this 200 was too near. As it is, price broke above the 56.20 and then pulled back on Friday, touched it to the pip, fingers in the fire, and has bounced away. I was also looking at the Euro USD, and again I forgot to cancel the orders, so I had a limit order in to buy at 130.70 as per my analysis. And I'd also mentioned a potential swing trade up here at 33.20. Now this actually would have worked, because earlier in the week when the price first came up and touched, you had a move down of 40 to 50 pips, move your stop to entry, and therefore bank some profits, but at least protect the trade, and therefore it wouldn't have been a loss. As I say, I was not around, I'd forgotten about this account this week, and it's just kept running. Swissy, I had an order in place. Right, initially I was looking for 9600 was the major pullback area, and also said to look around 93.60 for a potential short, and depending on where your stop was, then you had a potential for a few hundred pips there. As the week progressed, I did place an order for a potential move here, because Once you have this break of an area, you have a break of a significant area, which is this 200 EMA and previous support and resistance. As ever, you are looking for a pullback, and therefore the theory would have been, I think I placed this on Monday, price had broken down, on Tuesday, and I was hoping for a pullback up here. Other than that, the euro pound has been absolutely awful in recent weeks. This is usually one of my favourite pairs. It is usually very steady the way it moves, but look at these nasty wicks that we've been getting, and these are awful. This swing was 30 pips that way, 30 pips the other day. That was a horrible one. I had longed at 85.20 and that one lost. Aussie dollar, I was saying look for potential shorts at 9600. And again, dependent on where your stop was, I had my stop above here, and at the end I closed this on my live account because I didn't want to leave this over the weekend. It was only 20 odd pips in profit, and you have seen how we'd had a 100 pip gap last weekend. And that's the thing about trades over the weekend. On my live account, I never leave a trade open over a weekend unless it's got at least 100 pips profit locked in, because as you've seen, the scenario is what people don't often realise is if price jumps over your stop. Let's say, for example, let's go back to this Aussie dollar. Had you longed this pair the previous week and you had a stop here, let's say you had a stop around 94.50. Once price has opened on the Monday morning at 9400, your stop has been jumped by 70 pips. So you left it on the Friday thinking, okay, I've only got 30 odd pip risk here, but in actual fact, if price gaps and jumps over your stop, you have just lost 100 pips, and this can do major damage to your account, which is A, why we always insist that you place stops, and B, why, as I've just explained, I don't leave trades open over the weekend without at least 100 pips locked in. On to this week's analysis. This is the Euro USD on a weekly chart. I cannot believe that this is still bullish. It's just everything in every bone in my body tells me that this should be going back down again. But it has broken and fractionally closed above the monthly 55 EMA, which normally would have me looking to long. But I'm not overly confident. I mean, it does look technically, we've got stochastics moving up, we've got MACD in its favour, it's made this break of the 200 on a weekly and the monthly, so lots of reasons. Could be still on for a head and shoulders pattern here all the way back down again. It's very, very iffy for me at the moment. I personally was looking for a potential swing trade down here. I'm not going to long in its current position. It just seems completely, utterly illogical to me. There's also this weekend there's been an American economist, ex-Fed member, who has been saying that the Deutsche Bank, the main German bank, is dramatically underfunded. That could have an effect this weekend. And also this week we have the FOMC meeting again, and that is often as big a catalyst as NFP. So you're going to just have to be very careful. There's G8 meetings going on as well, so there could be all sorts of political speak either way to move this. I would be more interested if price comes back down, but if you're going to take a short, you'd counter trend. Look, everybody else has been buying, and therefore if you're going to take a short here, then you need to half your stake. But the other thing is, I had a potential short in place last week at 33.20. Now, if you have a look on the 4-hour chart, you can see how each time later in the week price came down to this area, it struggled and struggled and struggled. It has broken the trend line that goes back to the beginning of May, and therefore it gives you the kind of added incentive to go for it. But all of these candles here closed above 3300. So if you're looking for a short, I would wait for a clear move down below 3300, then a pullback with a view to a short. I will not look to long at the moment, and certainly not until the Fed have met. This is the pound dollar on a weekly, and again we have had a break above a major trend line and a 55 EMA here on the weekly. So this is a significant move, and I am more bullish on the pound than I am on the euro. And if you have a look here, what happened, we've had a clear break above that weekly 55. Look how that was resistance for a few days. Price failed to break, finally broke through. Then you get the M2 style pullback with a view to a further long. Friday's candle is a pin bar, and of the two I would prefer this one. So I will be interested to long at 56.20, and I will place my stop below, let's go above there, place my stop below this 200 EMA because, once again, this was previous support and resistance. It's 100 pips, which will frighten some of you to death, but all you do is you still risk exactly the same amount of money on the trade. You simply reduce the amount you stake per pip. The reason why I'm doing it, I'm risking 90 pips and I'm looking for a potential gain up here of around 180 to 200 pips. Could even go, we could be on for 160 for the pound prior to the summer break, and therefore long term that could be even a 400 pip moment. So there's a lot going on there that makes me think more bullish than bearish for the pound. This is the Swissy, and I showed you earlier how I'd left an order in place after last week's move on the Monday, Tuesday, and I had an order in place at 93.30. I think I'm more likely to move that down to 9300 tomorrow because this line was a little bit messy, but this is a trend line that goes back, I think this goes back to the beginning of the year. Yep, back to January. So this has been a significant area. Traders all over the world will have seen it, and therefore I am looking for a pullback anywhere around this area with a view to a further short. Euro pound, I showed you earlier, nasty euro pound at the moment, and it's not normally like this. But when it goes through periods where it's behaving as it is at the moment, I'm just going to leave it alone unless we get a clear break. If we get a break below 84.75, which is a 61.8, a clear break and close below and a pullback, then I will be interested. Only problem then is that the 200 EMA is only 30 odd pips below. So it's not the most attractive pair at the moment, but I would be interested in a clear break there. Last week I got my fingers burnt longing this here. Probably the best advice is just walk away and leave it. The Aussie dollar, and again we've had this major move. Previous week price was way outside the Bollinger Band, and as you know by now, price usually either returns into the band or at least waits for it to move back down. 95.80 was the major line in the sand, and teasingly price has just closed below it once again. Watch the other pairs, watch gold and see what goes on. There is big Aussie news out, I think it's on Tuesday this week, so keep your eye on that as well. But it has been, the difficulty with the Aussie dollar, it's been going, in previous weeks I was shorting at 96.60 area, and in actual fact that's probably a safer area because you notice here 3, 4, 5 occasions it was bouncing off this monthly 55 EMA, and therefore you're getting a better entry with it. So if you're thinking of a short on this one, 96.60 is probably a safer bet than 9600 at the moment. There was MACD divergence on here, where if you knew price has clearly been coming down and over the same period of time MACD's been going up, that's a clue that price could be on for a run back up. And stochastics again are just testing this 25 line, suggesting a move back up. If we get a bigger move and if we get an explosive move on the Aussie this week and it gets up anywhere near parity, I would definitely short, and I would short heavier than normal, perhaps double my usual stake, but it's because it is such a huge area. Equally, look at 9800, that was a major area. So it's not clear, but I favour a short. Certainly wouldn't be longing at the moment, but just be wary of clues that it might be on for a run back up. Dollar yen, showed you last week how that was the trade of the week, and unfortunately I got out too soon. It then has closed below the daily 200. Now, with the yens you need to be careful, and I want to show you something here. There has been talk in the last week or so of the Japanese bank intervening in this currency again. And what that means is that the Bank of Japan want the yen to be weaker against the dollar, and that was all going swimmingly. We've gone from as low as 76 up to over 100, and then prices pulled back. But the Japanese have stated they're going to weaken their economy. They're now printing money 24/7 like the Americans are because it helps their exports. And let's just have a look what happened last time the Bank of Japan intervened. This is March 2011, and this move, when the Bank of Japan intervened on this pair, price moved almost 1,000 pips in a matter of weeks. And what was happening was the yen was getting too strong. It was pricing their exports were too expensive, and therefore they were just losing market share. So what happened? I had said at the time 7600 was a good area for potential long. The BOJ intervened, and within 1 week price moved 600 pips because the Bank of Japan was simply dumping yen. And as I showed you, this move went 1,000 pips again. And this also happened with the Swissy. This is the Swissy versus the Euro. And the Swissy was just getting too strong. It was killing their export trades. And therefore the Swiss bank said they would do whatever was necessary to weaken their currency. And once again, we had a move here of 2,000 pips in a matter of a month. And look how it just stabilised here. The Swiss National Bank, every time the Swiss franc started to get strong, they just dumped it again. And they were controlling their own printing presses. They were just printing more money. And it has gone on and on and on and really made the Euro Swissy untradeable ever since. So the danger is, the rumour mill is going that the BOJ may get involved. They will be under pressure this weekend at the G8 meetings not to do so, but do not be in more than one yen trade at a time, because if the BOJ suddenly intervene and you are short, you are going to get whipped out. And not only will you get whipped out, the danger is, as I've just shown you with the gaps, you could find your stops are jumped over. It is dangerous. Be careful. So, what do you do with this dollar yen? Well, at the moment, you're only looking for shorts. And unfortunately, the best place for this is all the way back up here around 98.30 for me. So it's got to pull back 300 or 400 pips. You know by now that I only trade 1 yen in a week, and I try to pick out the best one of the three. Last week I was spot on with the dollar yen, and this week I prefer the euro yen, and the reason being the euro yen has broken a weekly trend line that goes back to November of 2012, and therefore once again traders all over the world were watching this. You could have got in here last week. Anywhere around 12800 for a pullback, I will short this pair with my stop the other side of the trend line and the EMA, because, as I've just explained, that is a break of a majorly important area of support and resistance, and everybody all over the world is watching it. And the good thing here is this could fall and drop like a stone all the way down to 120, because there's nothing in the way underneath it. This is the Aussie dollar yen. The Aussie dollar yen is at the moment coming down to a trend line. The stochastics are starting to turn back up. There's the 200 EMA not too far below. This is a weekly, so it's 140 odd pips. I am less inclined to take this one for reasons just explained, and therefore prefer the euro yen this week. What I am interested this week is the CAD. I don't often trade the CAD, but when I do, I only trade the CAD at major areas. And in recent years, those of you been with us, last time in 2012, we simply shorted at the weekly 55 EMA, and we had 10 out of 11 winning weekly trades on this pair. Then price broken above, and then it did it again. In late 2012, price was again bouncing off this area. And then resistance became support, and off we went. And then we had in March, April time, price came down, touched it, fingers in the fire, and bounced away again. So that is a major area for me on the CAD, as is 100 parity, hugely significant. And therefore, the way I'm going to play this week is as follows. I am going to place half of my trade at 10100, and the reason is this is 78.6 of the recent move, as well as the weekly 55 EMA just below. Now, you have a number of options here. One option is you can simply place your stop just below the EMAs, and in actual fact I'd go to 10045, because the CAD often will bounce off the whole numbers and the 50 numbers, so I'll go for 10045. However, the other way to play this is to say, okay, I am going to risk X amount of dollars. Let's say you're going to risk $500 on the trade. I'm going to risk $250 here, and I'm going to risk $250 here. And the reason being that price may only get down to here and bounce back off. And if you've just got a trade down here, the more conservative trade, then the danger is that you don't get a trade. So this is significant. This whole area is significant. The other way to do it is you can place your entry here and you place your stop below 100. And what you would do, so you'd have one stop with 100 odd pips, but the second one you would only have a stop of 20 or 30 pips, because you would go just above 100. And last time we actually got filled at 10020. So look at 10020, and then go just below 100. But you risk the total amount as normal. If you're a more conservative trader, then wait for price to get all the way back down here. There are clues that we're on for a move down on the CAD. This is the weekly chart. We now have a 5-8 cross forming, which should print at the market open. Stochastics are pointing down, and we have MACD divergence. So there's a lot of clues here that the CAD could be on for a run. And therefore, if you want to be more conservative, look down here at 10020, or look to split the trade, or just be aggressive and just go all in at 1.0100. The CAD can be nasty, it can be erratic. Do not leave the order in place once the FOMC news comes out, except if price hangs around here, and that means it's 160 pips above 100. If the FOMC news comes out that is bad, I would cancel this order for a start off prior to the news. But what I might do is leave half of a potential trade in here at 10020. And the thinking behind that is, if you get a big move from the news of 190, 180 pips, where is it most likely to stop? Well, the most likely area is here again. Not for the more conservative amongst you, and not if price is down near here anyway. But if price is up here, anywhere up here, then I may well leave the order in for FOMC. It's not my standard method, but it's just the fact that you often will see moves to a major area and then fingers in the fire and price bounces back off again. Okay, number of options, all explained as the write-up as well. Have a great week.